Harshvardhan has a very strong background in equity research, fundamental analysis, business valuation of companies in the financial services space, that is banking, NBFC, AMCs, brokers, and the new age financial tech companies. Before joining Bandhan AMC, he was associated with Motilal Oswal Securities and Infina Finance, that is Kotak Group company. Harshvardhan has a Bachelor of Engineering degree from Mumbai University and MBA in Finance from SP Jain. He is also a chartered holder of a CFA Institute USA. Good evening, Harshvardhan, and very warm welcome for today's session.
Thanks, Swati. Hello, everyone. Right, so I believe we can start now.
Yes, very much.
Great, perfect, great. Thanks everyone for taking time out on a Friday evening for this session on our NFO from Bandhan Financial Services Fund. So without further ado, I'll quickly run you through the presentation. I intend to keep presentation very short and sweet, maybe 20-25 minutes. So the idea is we'll go through the presentation, we'll discuss the landscape opportunities, and maybe we'll take a few questions or probably any questions that you have on this fund. So let's just start with Bandhan Financial Services Fund. So with this fund, what we are trying to tell you is that we are trying to unlock a vault of opportunities in the BFSI space. Now, BFSI, when people talk about, the first thing that comes to mind is banking. This is a banking fund, but that's not the case. What we want to highlight is definitely banking is a large and dominant space in the BFSI part, but outside of that, there's a huge number of companies which are present, which includes your insurance companies or capital markets companies, your other players which support the capital market companies, a range of fintech companies, which provide a very exciting investment opportunity. So what we'll do is we'll have this presentation in three parts as to why financial services as a sector, why now, which is very pertinent looking at what has happened in the markets in the last, say, one month or 6 weeks, and why Bandhan Financial Services Fund and why not any other one. So these are the three key points that we'll be discussing. Firstly, why financial services? So the key point here as to why financial services is this one data point that I would like to highlight. What it says is rupees 1,000 invested in Nifty 500 in March 2005 would have grown over the period and would have given you 10,700 rupees by the end of March 23, or maybe say close to 10,800 or 900 by the end of June 30th. But the same money, if you would have invested in but in a financial services index, which is Nifty Financial Services, that 1,000 rupees would have grown to 18,800 rupees by the end of March 23. What it means is Nifty has given you a CAGR return of 13.7% on an annualized basis, which is roughly say 10x or 11x of the money invested. But financial services sector has given you a CAGR of 18%, almost 18%, which is 18x of your invested money. So effectively over an annualized period, what you're getting is around 200 basis points, or let's just say 2% higher returns annually. So which gets compounded over the period. It means 80% ka difference hai, 10,000 and 18,000. So the gap is like almost 80%. So that's the kind of returns that you tend to get in a financial services space. Now, as I alluded initially, generally the perception is BFSI bole to banks, which is, again, as I said, which is true because banks are dominant. But outside of that, there is a whole host of companies, whole host of sectors. So if we start from your bottom left, we have insurance space, general insurance, life insurance, there are insurtech players. Now, 10 years back, there was hardly any insurance company listed. But today, you have 2 or 3 general insurance companies listed, 4 or 5 life insurance companies listed. The largest company, life insurance, LIC, got listed last year. You have a few companies in the insurtech space which is there. Similarly, there are capital market companies. brokers, asset management companies, your RTAs, your depositories, your rating agencies. Most of these companies were not available 5 years, 7 years, or even 10 years back. But today, a large number of those companies are available. Fintech companies, I anyways alluded to a few names that's there. Outside of banks, there are NBFCs. The popular ones like Bajaj Finance, Chola Investment, Mahindra, Sundaram, those kind of NBFCs, your housing finance companies, your microfinance companies. Again, microfinance as a sector probably didn't exist in 2010, but today if you see, there are like, if I recollect, 4 or 5 pure play microfinance companies listed. So the point to highlight is this sector, when BFSI is not just banks, it's a huge sector. Now, just to give you some numbers around it, what are your numbers in the sense the number of companies listed in the BFSI space? On the BSE index, or as per AMFI classification, if I were to look at, there are like 200 companies listed in the BFSI space. Probably most of us would only know the name of top 10, 15, but there's a huge range of companies available post those 15 names. So that is what the kind of opportunity the BFSI space offers. Now, how big the sector is. One parameter to look at the sector is what's the contribution of that sector in our GDP. So if you want to look at India's GDP, people call it what? In dollar terms, $3.5 trillion, roughly around that number. If I were to convert into rupees, roughly say 300 lakh crores is the GDP. Financial services contribute somewhere around 20% of that. So 20% of 300 lakh crores is like 60 lakh crores of GDP contributions coming from this single sector. Now, this is something how financial services as a sector touching every common man out there. Everyone has heard of Bandhan accounts, Aadhaar accounts, Jam Trinity. So I won't get too much into here, but the only thing that I want to highlight how this Bandhan Jam Trinity is impacting is looking at the growth of UPI. So to focus on UPI, you focus on the blue chart at the bottom, the blue shaded area at the bottom, how it has grown rapidly from 2017 onwards. So currently, of all the digital transactions happening in India, UPI plus IMPS, which is your NEFT and those kind of transactions, contribute somewhere around 60% of the total transactions. And if I were to give you just some numbers, in a month, there are like 15 lakh crores of transactions happening via UPI. So imagine that's happening today, and that number was probably just a few thousand crores in 2017. Look at the growth. Imagine the growth what would have when this would further grow, say in 2026, 2027. So that's the kind of enormous growth that we're talking about. Obviously, what the sector offers. So as I've been harping upon, it's not just bank, it's diverse sector. Some 200 companies available for investment in this space. Obviously, no one is going to invest in 200 companies, but that's the kind of variety, the differentiation that the sector offers. It has a large profit pool. Now, in terms of profit pool, again, someone would ask, kitna bada hai? So the answer is, the financial services companies nearly contribute 30% of the corporate profitability in India. Now, there are some numbers of around the total corporate profitability is ranging between 6 to 10 lakh crores every year. So 30% of that. So we are talking about what? Between say 2 to 4 lakh crores of total annual profits coming from this sector. Again, that's the kind of opportunity that we are playing for. Now, I gave you data that around there are 200 companies available for investment, and there are a huge number of companies outside of banks. But what's that? Can I give you some examples? So, if you were to look at the top left corner, which is banks, public sector banks and private sector banks have been listed for ages. So, if you were to look at between 2010 and 2022, or say 2023, how many of them got listed, or like what's the growth in that? There were 10 public sector banks listed in 2010. Today there are 2022, which is December 22, there are around 12. So not much growth. Private sector banks 16 ke 20 over. Again, not much growth. So the growth is actually coming outside of banks. You have small finance bank, you have category nahi tha pehle. In 2010, small finance bank, payments bank, a category didn't exist. Today we have some five companies listed in that space. Asset management companies. In 2010, there was only one company which was classified as asset management company. Today we have who's of the asset management of the AMCs listed. We have depositors listed, we have clearing houses listed, we have rating agencies listed. A whole host of stockbrokers got listed in the last decade. Same way, if you come on the right hand side, microfinance institutions. That sector again, as I said, probably didn't exist or was not available for investment. There was only one company listed. Today we have 4 or 5 companies, pure play MFI companies available. Same way you have housing finance, asset financiers, fintechs, and the insurance sector that I talked about, giving us a large opportunity to invest. It gives us a flexibility to pick and choose the companies which can give us good returns. Now this is just to again highlight the potential in India's story and potential in the financial services. Look at on your left side, look at where India stands. Credit to GDP ratio, 88%. The government has a target of $5 trillion economy by 2025. This 5 trillion will obviously grow, right? One day it will become 8 trillion, 10 trillion, 12 trillion. And the credit to GDP number, which is effectively the loans given by the banking system and the NBFCs divided by the GDP number, which is 88%. Look at where the developed economies are. Number is much above 100. So as the economy grows, the credit to GDP number will grow. What it means is the growth in the financial services over a period of time will be higher than the GDP growth. So if a GDP is growing at 6-7%, financial services sector will probably grow at 15% because that is how the history is. Typically, financial services grows at 2x of the GDP growth. So that is the kind of growth we have seen in the last 20-25 years. The expectation is that kind of growth we are going to see in the next 5-7 years or maybe 10 years. This is the same data that I talked about as to the credit growth in a country like India is typically 2x of the GDP growth. Now this is just one data to highlight how good or strong our banks are today. So what the key thing to look here is the regulatory requirement, which is at 11.5%. In 2016, say FY16, the regulatory requirement was 11.5. The banks were at 13.3. To less than 200 basis point ka buffer. Today we are at 17%. The kind of buffer these banks have today, via capital infusion, via reinvestment of the profits and back in the business, they have created a big buffer. What it means is, if there are any macro shocks or any large shocks that come in the economy, the banks are much better placed to absorb that shock as compared to say where they were standing in say 2015 or 2016. So banking system is in a much better shape today. This is the data point of how the credit has grown in India. In December 2009, the total loan size in India was 26 lakh crores. Today, one bank alone, which is the largest bank in India, has that kind of loan book of 25-26 lakh crores. The total system has grown to 1,30,000 crores. Sorry, 130 lakh crores. So that's the kind of total loan book that only bank has. We have not even touched upon the NBFCs, the housing finance companies. This is the data of the loans given by NBFCs, loans given by housing finance companies. NBFCs is like 30 lakh crores. Housing finance companies is 13 lakh crores. So that's on the lending side. What about the non-lending side? Now this is some data which we, the AMCs, the brokers and everyone probably know and they see it every day. The kind of cash turnovers we are seeing in the markets today. 10 years back, the daily cash turnover was at 20,000 crores. And I'm talking about daily cash turnovers. Today, that number is 60,000 crores. The growth of 3x in 10 years. That's on the cash part. FNO part, it is phenomenal. Today, the daily turnover in FNO is 150 lakh crores. How many zeros are there in that? It's difficult to fathom, but that's the kind of growth we have. Number of demat accounts, 11.5 crores at the end of FY23. Today, as of June, end of June, we are almost crossed 12 crores demat account. Now this number is very dear to the AMCs, right? 14,000 crores monthly SIPs. Look at the AUM number, 42 lakh crores. The key point in all the charts here, apart from the numbers that I've been talking about, is the trend. We are on a secular uptrend. So maybe there could be aberration for a few quarters or a few months here and there. But if you were to zoom out and look at what is happening in the 7 years, 5 years, 10 years thing, you would realize that there's phenomenal growth happening in India, especially in the financial services. This is again to highlight the insurance, the potential in insurance. This is the total insurance premium collection in India upon the GDP number. So I talked about India's GDP at somewhere around 300 lakh crores. 4% of that is the insurance premium, which is what, 12 lakh crores is the insurance premium collected every year in India. Global average is 6.8. We are not even talking that India would reach to the developed standards, 11.7% for US or say 14% for Taiwan. We are saying even if it grows to the global average, combined with the GDP growth, the growth in insurance sector will be again much higher than the GDP growth that we have seen. And last but not the least, the upcoming space, the fintech. Fintech companies, they tend to give you very interesting names, insurtech, wealth tech, falana dimkana. But the idea is these are upcoming spaces. This is upcoming sector. One can probably argue that, you know, there are hundreds of companies in fintech. Everyone is starting a fintech nowadays. Most of them will fail. Probably yes, most of them will fail. But the point is, the ones who will survive, they'll become big. And our job is to identify the companies that will survive and that will become big. So that's on the financial services part. The idea was to tell you how big the landscape is. It's not just bank, it's insurance, capital markets, AMCs, NBFCs, fintechs. Another key point is the sector is growing 200 basis point to 300 basis point higher than the nominal GDP. Your nominal GDP typically grows at 12-13%. Real GDP 6-7%, 5-6% inflation, 12-13% growth in nominal GDP terms. Financial services sector tends to grow higher than that. 15-16% is the long-term average growth in the sector. So this is a sector which grows faster than the GDP. Now, why now? Now, this is something that everyone talks about, especially as I said, in the last 1 month, six weeks, what you have seen in the markets. Everyone talks about, is it like, should we invest now? Is it like a large part of the rally is over? My answer is no. Why? I'll give you 3 different aspects as to why that's not the case. Firstly, one way to look at it is the PE ratios, as to where is the sector PE, where is the broader market PE, versus also look at the sector PE versus where is the average, how the long-term average has been. So if you look at Nifty PE, Nifty 50 ka PE, so this is the number that you should look at, 21.5, the number in the red. That's the Nifty 50 PE. So that is the PE of Nifty 50 as of April. But now you would say कि boss rally तो May June में है. Even if you take that May June का number, as of 30th June, Nifty 50 PE is at 22. So that number hasn't changed much. 21.5 has gone to 22. So not much of a change. Similarly, if you were to look at the PE of financial services companies, as of April, it was 18.1. Today is somewhere between 18.5 to 19. So it is still below the Nifty PE. But financial services is a sector which tends to outperform Nifty during a bull market. So you would see in the chart that whenever there's an uptrend in Nifty, the PE of financial services sector goes much higher than Nifty. So we are not there yet. वो stage आया ही नहीं अभी. We are still lower. Similarly, the long-term average PE of financial services, it's at 22.2 to be very precise. Currently, we are at what, 18.5, 19, somewhere between that. So also, it's not that on a long-term average basis we are trading above the long-term average. That we're still far away from that also. Sorry. Yeah. So now this is another data point that I want to highlight. That if we were to look at the returns of Nifty of the financial services in versus the broader market, Nifty 500. Look at the 10-year returns and the 5-year returns. Financial services have given you 100 basis point or 200 basis point higher returns over 5 years and 10 years. But what's about in the last 3 years? Almost the same returns, right? Not much of a change. So the point here to highlight again is what has happened in the last 5 years or 10 years. Things are not there yet. We have not yet reached the peak. So if this 3-year index, when it starts moving into 5 years and 10 years, what we would see is that underperformance catching up with Nifty. So today might be the right time to invest in a financial services space, because the rally maybe has just started. It is not that we are at the peak of the rally. And lastly, this is the data point that I want to highlight, and this is one of my favorite data to show that why anyone and everyone should invest in financial services. So what we have done here is we have, of the last 15-17 years data, we have broken it up into a block of 4 to 5 years, and then compared as to in that 5-year period how financial services has performed over Nifty 500. So how to read this data is very simple. In year 2007, Nifty 500 gave you 62% return, but Nifty financial services gave you 85% return, which is a 22% outperformance. My bad, sorry. क्या हो गया? Yeah, is the screen visible now? Someone can please confirm?
No, screen is not visible.
Oh, one second. I'll share the screen. It's visible now?
No, not yet.
Not yet?
Presentation is not visible. Do you want me to share?
Yeah, if you can share, that would be helpful.
Sure, just give me a moment.
Yeah, I can continue.
Sure.
Sure, great, thanks. Yeah, apologies for that. So the point here I was trying to tell that in 2007 alone, financial services gave you a 22% outperformance. Similarly, around 1.8% outperformance in 2008, maybe -2, say 2% underperformance, -2% in 2009, 16% in 2010, and some -1.6 in 2011. So if you were to add this up, you get a 36% outperformance over Nifty 500 in that 5-year period. Similarly, if you were to look at 2010, 2012 to 2015, over that block, you got a 25% outperformance. 2016 to 2019, sorry, 37% outperformance. But what now? Because what matters is what we do now, right? We have to invest money today. 2020 onwards, financial services has been underperforming the broader market by around 21 to 23%. Now this number 23 has slightly come off now. Maybe it's still at 21%. So there's still the financial services are really not caught up to the long-term averages. So what it means is that today the financial services sector provides you a very good entry point, because if the history were to repeat itself, financial services would tend to give you around 25% outperformance in a 5-year period. We are currently at -20. So imagine this -20 has to go to, say, on an average +25 over the next 2 to 3 years. So that's the kind of alpha generation or the returns that we can potentially see in financial services fund or a financial services sector as a whole, because of where the point that I mentioned, it grows faster than the economy, the large number of companies that are present in the sector. Ma'am, if we can please move to the next slide. So that brings me as to why Bandhan Financial Services. Now, obviously, because now the question is, because financial services sector is great, everyone agrees to that probably. Today is the right entry point. Valuations are better. That there has been an underperformance in the last 2-3 years, which would probably there'll be a catch up over the next 2-3 years. Agreed. So then why Bandhan? Why not someone else? There are nearly every AMC out there has a financial services fund or a banking fund. So how will we differentiate ourselves? The point that we try to put forth, or we are saying that how will we differentiate ourselves, is due to the portfolio construction approach that we are taking. The portfolio construction approach that we are taking is it would be an actively managed fund. An actively managed fund, what we're saying is we'll be taking a flexi cap approach. What it means is we are not going to get bias that we are only going to invest, we are going to say we're going to invest X percentage in a large cap, Y percentage in a mid cap, and only say a very small percentage small cap. We are not going to do that. What we are going to do is we have the universe of around 200 companies. From this 200 companies, we are going to choose companies bottoms up. We are going to go through the company's ability to grow, company's ability to deliver growth, company's ability to deliver profit. Okay, is the company growing faster than the sector it is in or the subsector it is in? If yes, can it deliver healthy profits, healthy returns? If yes, is the management pedigree good? If yes, so probably that company will be in our portfolio. The market cap won't matter. We are going to be a market cap agnostic. It would be a growth oriented portfolio. Growth oriented means the company can grow faster than the other players in the market. Say for example, an insurance company, that this insurance company has to grow faster than the other insurance companies in the market. So that is what I mean by growth oriented portfolio. It's obviously an actively managed fund. Apart from that, so a few portfolio construction criteria: earnings trajectory, which is an outcome of growth. If the company is growing faster, if the company is growing, can it also deliver profits? Growth is one thing, but profit has to come. In financial services, corporate governance and management quality is paramount. That becomes a heart of our portfolio construction criteria. We are going to give a lot of weight to management quality. And obviously, combining all these things, look at the return ratios. Are the companies giving you good ROAs, good ROEs? Can the company wither a storm in the business cycle? If yes, those companies will be there. The point here I'm again trying to emphasize is it's not that we are going to stick to just top 5, top 10 or top 15 companies. No, that's not going to happen. Our active share will be much higher than the peers. We are targeting an active share of between 30 to 40%. My understanding is no one in this space has such high active share. Typically, most of the funds would restrict themselves to 20-25% active share. What I mean by active share is the percentage of portfolio which is outside of the index. That is where probably the alpha will come from, because that is where the companies are today small cap, will maybe tomorrow become mid cap or maybe large cap at one point in time. So we have to identify those companies today, right? The companies which are going to become large cap tomorrow, we are going to identify today. So that's the whole idea towards our portfolio construction. That is what we are going to do. That is what we bring to the table. Now, ma'am, if you can please take it forward. Now the question is, for whom this fund is suitable. Now, I being on the fund management side, it's difficult for me to judge who the fund is, for whom this fund is suitable, but that I believe you guys are the best judge of that. You guys meet your investors on a daily basis. You understand their risk appetite, what phase of their investment cycle they are in. But my understanding is this is typically a sector fund, maybe some satellite allocation, core satellite portfolio allocation in the satellite portfolio. That is where this fund would typically fit in. But as I said, you guys are the best judge of your client's portfolio. Ma'am, if you can move forward, please. Yeah, these are the fund managers of the fund, Mr. Sumit Agrawal and Mr. Manish Gunwani. If you can just quickly move forward. I think there is a slide on the risk factors. But anyways, I'll quickly take you through the risk associated with this space. See, everything in our life unfortunately has some terms and conditions. So that's the case with this fund also. The risk typically are your macro risk. Financial services has a lot of linkages with the global macros. The Indian economy is getting highly linked to the global macros. So anything happens there, obviously, it would have an impact. So there could be some risk involved there. This is a highly regulated sector. You have multiple regulators, SEBI, RBI, ADA, and whatnot. So in any action that a regulator takes will have an impact. In lending is everything about interest rates. Some global macro event, some regulatory event, RBI increases interest rates, decreases interest rates, will have an impact on the margins in this sector. Credit risk, which is one big risk, right? In lending, writing a check is very easy. Collecting that money is difficult. So all lenders, non-lenders, NBFCs, they typically face a credit risk. So those are the few risks associated with this space. But I'm pretty sure that the sector will do well. Now to quickly summarize as to some 3 or 4 points that why financial services, why to invest today, and why Bandhan Financial Services. So these are 3 or 4 key points that you can probably use to pitch to your investors as to why you have to invest in our fund. Firstly, financial services is a large sector which I've been harping upon for quite some time. This sector over a long period has given 2% higher returns in the market. Remember that numbers, 1,000 rupees invested going to 10,000 in Nifty, but 1,000 rupees going to 18,000 in a financial services. So that's like 200 basis point higher returns every year. So that's one thing. Secondly, the slide that you have on your screen. There is an underperformance in financial services over the last 3 years, but this has never happened in the past. Over a block of 5-year period, financial services has given around 25 to 30% outperformance over Nifty 500. So this could be an opportune time to enter the financial services sector, have an allocation to this sector to get that alpha in the portfolio. That's the second point. And lastly, why Bandhan? We are offering you a portfolio that is actively managed. A selection of companies which are growing faster which would grow faster than the market. And we are going to have a bottoms-up stock selection. Now, the beauty of bottoms-up stock selection is that has a very high success rate in identifying multi-baggers, which would eventually mean that potentially your returns in a portfolio which is constructed with this approach would be higher than your broader market returns. That's the thought process in constructing this portfolio. So these are 3 or 4 points that I would want to leave you with for why financial services and why Bandhan Financial Services Fund. So with that, I end my presentation, and I'm happy to take any questions that you may have at this point. So the question is, what are the current trends in financial services industry? So I think uh, this is a very broader question, but what I understand from here is what we are looking at is what's our view right now? How do we see the sector panning out? I think that is what the person wants to understand. So I would just like to highlight that if you were to look at the data point that I was highlighting upon, that this sector keeps on growing at 2% higher than the nominal GDP. So if you were to look at the recent data, banking industry is growing at about 15%, NBFCs are growing at slightly higher. Also, if you would have been reading the quarterly updates which we are getting in the companies right now, because they've just completed the June quarter, and the kind of data updates that we're getting from them over the last 5-7 days, what it's indicating that this year probably the credit growth could be even higher. 15% could be even 16%. At an industry level, so that there would be few companies which would grow even higher than that, maybe at 20%. That's the possibility. The profitability growth for the companies today within our investment universe, what we're seeing is somewhere between 15 to 17% or say 16 to 18% is the kind of profit growth that we're seeing in those companies. So I'm not sure if that was a question which was asked upon, but I believe I've answered it to the best of my ability. Or if the person can further elaborate it, I'll be happy to answer it. Yeah. What are the most focused financial services sector? Where will we allocate the most? Yeah. So this is a very good question. So as I've been saying that we really don't have an affinity, or we have not created a mind map because most of our allocation will go into bank, or it would go into insurance companies. No, we don't have that mind right now. What we are seeing is we are evaluating companies bottoms up. If we find a company, like hypothetically, for example, let's just say in capital market space, we find that company growing to be faster than the sector, valuations are attractive, we feel the profit can grow fast, we'll have that company will get a decent allocation. That company might very well be a bank. If you find a bank which can grow faster than the sector, it can deliver very good ROAs, that bank will get an allocation. So we are not saying that we are not created any buckets sort of thing. Banks will give X percentage to banks, Y percentage to NBFCs. We are not doing it. What we are saying is it would be a bottoms up approach where the active share will be higher. You'll find a lot of companies which are not in the index but are there in our portfolio. So that's what our approach is. Today the market has crossed all earlier levels. The interest rate is high. What if tomorrow this comes down? How that would be taken care of? So the point that I've been saying that today the market has crossed earlier levels, which is true, right? Because probably we at an index level we are at all-time high. But again, going back to the point that I was saying, if you were to look at valuations, the PE multiples or even price to book multiples for financials, they are below their long-term averages, or in fact they are even below the Nifty levels. What it means is that the financial services companies have really not participated in the rally as much as they should be. It means our entry points today are relatively better as compared to other sectors. That's the first part. Now, the interest rate is high. What if tomorrow this comes down? How that will be taken care of? Very fair question asked, because in lending, interest rates is money is a raw material, and interest rate is the price I have to pay for that. What if tomorrow it comes down? Does that mean the yields will decline or the earnings will decline? Now, typically, banks in India have been very smart, and you guys would have also noticed, most of us have home loans from banks. You would have noticed that when interest rate rises, banks are smart to pass on the higher interest rate to us. From 6.5, it became 9 for me, my home loan. in less than in what 1.5 2 years. I'm pretty sure when these interest rates come down, when it say hypothetically if it goes back to 6.5, my bank will not decrease my interest rates at the same rate. They'll figure out one way or the other to to manage the margins, to increase their profitability. So that is how these banks are, or NBFCs are. So that is what we are banking on. Okay, that they will figure out revenue opportunities even when the interest rates are coming off. And mind you, when interest rates come off, banks tend to get a lot of profit from their investment portfolio. You would, if so today we are probably a stable interest rate regime. As and when the interest rates will start coming off, you would realize banks are booking a lot of profit from their investment portfolio. During the quarters which will happen, you would notice there's a spike in the other income of banks, which is coming from their holdings of G-Secs and other securities. So that is how banks do manage the earnings. I hope I've answered the question.
I'll read out the question, Harsh.
Yeah.
What would be your take on the fund outlook for 3 to 5 years from now on?
So the fund outlook, is it the person wants to understand in terms of the growth, the profitability growth? Maybe that is what he wants to wants to understand how the growth will be. So obviously I cannot talk about returns, but what I can talk about is the kind of growth that we are seeing in the investment universe, or the companies that we have under our coverage. What kind of growth or return ratios that we are looking at. So I did kind of alluded to 16 to 18% profit growth within our investment universe. So if you were to extend that numbers into 3 years, 5 years, you would typically find between 15 to 18 or 15 to 19% CAGR growth in profit during that year, over the next 3 to 5 years. Compared to that, what is the broader sector profitability growth rate, right? Because we may not have all the companies in our fund. So the sector typically would have say 15 to 17, 15 to 18 kind of percentage growth CAGR. Our coverage companies would typically have say 15 to 19. That would be a broader range, because some subsectors may have relatively lower growth, some sectors may have relatively higher growth. So that's a broad range, or maybe 16 to 19% profit growth is what we have within our coverage companies.
So the next question is, if you will see the major allocation in all the existing schemes are comprised of BFSI only, do you seriously feel the need to launch this fund separately based on the financial service sector?
Right. So what I understand here is the person is trying to compare financial services fund compared to say a large cap scheme or a flexi cap scheme. That is what my assumption is. Correct me if I'm wrong. I can come back to that.
Yeah, because if you see the many existing funds are there who have larger portfolio in BFSI.
Absolutely. So the 2 or 3 points that I would like to highlight here. One is of those other schemes, say large cap, flexi cap, mid and small, or core equity, whatever the larger gamut is. What happens is their BFSI would have what, say 25, 30, 35% allocation. Now, if this sector is going to give you 200 basis point higher return, what you're going to get is 30% on an average basis, and that's the allocation, into 200 basis point, or 20 or 2%, which is effectively a 60 basis point impact on your fund. But here, this 200 basis point will be entire 200 basis point kind of return that you're going to get over the broader market. That is one part. Secondly, if you were to look at those schemes, you would find companies allocation to BFSI companies which are largely in the top 5, 7 or 10 companies, which are what we tend to call hugging the index. They would have names only from the index, maybe some weightages would be different. What we as a separate financial services fund are offering you is a larger active share, around 30 to 40%. What we are saying here is there will be a large number of companies in our fund. We intend to have around a portfolio of around 35. Don't hold me for that. We could have a few more, a few less. but largely that number of companies in the fund. There will be many companies in our fund which are not part of the index. What it means is that we are actively looking for companies which can give us higher returns, which may not be there in the funds that the other schemes that we are alluding to, the large caps or the mid caps or the flexi cap schemes.
The next question is, what portion do you find in bringing the NFO at this point of junction?
What potential do you find? So yeah, so again, this is again going back to the 3 point that I've been repeating. The potential in the sector, it gives you around 2% higher return than the market. The timing, which I've been saying that typically BFSI over pack of 5 or block of 5 years give you 25% higher returns, but today this sector is like negative 20%. It means the possibility of getting an alpha from this sector is much higher. The probability of getting alpha from here is much higher than at any other point in time. So that is why I feel that this today is the right time to invest in financial services, and that is why we believe that we are bringing a product which is very suitable for the time we are in.
Right. So there is one question again linked to this only, which says that, so is this fund suitable for both bear and bull market?
So I would say for both bear and bull market, absolutely yes, because that is what an actively managed fund intends to do. That what active management actually gives you. You would have noticed that I've never shared any specific number. I'm not saying ki X would be the active share. I'm saying I'm giving you a range between say 30 to 40%. I'm not saying exactly what number of companies we have. We are giving you a range. The reason why we are doing this is because depending on how will the outlook that we have for the market, if we believe that there is going to be a decline, we would probably pull back. We'll reduce our active share. We'll come back to a lot. We'll reduce our active share. We'll try to invest in more defensive companies which tend to decline less when the markets fall. When we're seeing a good growth potential ahead, we may go overweight a stock. So that's the kind of thing that an active manager does, and that is exactly what we'll do. The idea is to capture the maximum of the bull cycle, and during bear cycle, the decline. The idea is that we decline lower than the market. So that is what exactly active fund management brings on the table, and that is exactly what we are going to do.
That's the last question it was. I think all the questions are done now. Yeah. So thank you so much, Harshvardhan, for giving the insights on the fund. Thank you to all the partners for being here today for this NFO. We look forward for your participation on it to get more investment on this fund.
Thanks everyone for sharing time on a Friday evening, and we look forward to your participation and your contribution in the Bandhan Financial Services Fund. Thank you. Thanks everyone.